Edge designations, CFA level 1, pre-reading, financial statement analysis, learning module 3, balance sheets. We continue onwards with the third reading in the financial statement analysis learning modules. Learning module 3, balance sheets. As per normal, we put the learning outcomes for the particular module here on the front page, and as you can see, there are not too many. Where we'll find more detail, of course, relating to balance sheets. This is the pre-reading, but remember, there's another reading that we are going to get to see later on when we move out of the pre-readings and we move to the core readings that are required for the syllabus. There is another reading, another learning module directly on balance sheets, as there are for all of the three statements: income statement, balance sheets, and cash flow. There's a reading in the pre-read, and there's a reading as well, a more advanced reading then in the core material. Let's get ourselves going straight away. Not a very long reading. Let's get going straight away. And we start off, and it says the first learning outcome statement: describe the elements of the balance sheet. And as we know, assets, liabilities, and equity. And just for a little bit of quick revision, nice and easy, okay, always just to remember, okay, that we go back to the oldest equation that there ever was, that assets equals owner's equity plus liabilities. And not much has changed there since almost forever. Okay. And let's hop straight in. Okay. Assets are resources controlled by the enterprises. I'm going to just read you the formal definition. As a result of a past events, but what do we expect? We expect future economic benefits to flow to the enterprise as a result. Assets are what the company owns. We move down to have a quick look then at liabilities, and if assets are resources, liabilities are obligations also arising from past events, which we will need to settle, okay, in the future. Okay. And when we settle the liabilities, what will that result in? An outflow of resources embodying economic benefits. And that liabilities are typically what the company owes. Equity, whenever you see the word equity, generally speaking, a nice word to go together with equity is residual interest. In other words, assets less liabilities. If there's anything left over, I've got more that I own than more what I owe. Okay, then I've got a equity position, which is really assets less liabilities. Okay. Describe the uses and limitations of balance sheets as we look to financial analysis. Okay. The balance sheet, remember, the balance sheet is broken down predominantly into two major parts. Okay. Long-term assets and liabilities, generally those that are over 1 year old, and then shorter term, or what we call current assets and liabilities. Longer term measures solvency, in other words, the longer term ability to be able to survive as a business. Liquidity is more in the short term. So for liquidity, we're going to look more at things like current assets, current liabilities. Solvency, we look more towards non-current assets and liabilities. Okay, let's have a look over here. There's a mixed measurement model on the balance sheet. Okay, and we've got to be a little bit mindful of that. Okay, items on the balance sheet are not always at their fair values or market values. Okay, remember, several of the assets and liabilities that sit then on the balance sheet are measured at historical cost. Sometimes there's adjustments made to them. Okay, and obviously one has to be careful when using the balance sheet, the exact detail that you're working with. Okay, even if all the items were kept at a nice fair market value or current value, we've always got to be concerned that, remember something about the balance sheet, very important, as opposed to that of the income statement. The balance sheet is at a point in time. You always see on the top of a balance sheet for so-and-so company as at a specific point in time. Income statement is for the period ending. So income statement could be for as long as a year, so you get a nice good look, a good picture of what happened for the entire period that you're looking at. Whereas a balance sheet looks at a specific point in time, and of course things can change since the reporting date. Okay. Several indicators of value that are not necessarily included then on a balance sheet. So what are some of those? Future cash flow projections, expectations, the company's reputation, management skills. These are all things that perhaps were not found then on a balance sheet. Just be careful, of course, and balance sheets are very, very useful bits of information, but again, just to always be mindful of what they're good for and what they don't add so much value for. Top of page 3, describe alternative forms of formats for balance sheet presentation. We've got the report format. All assets, liabilities, and equity are presented in a single column. You've got the account format, okay, assets on the left, liabilities and equity on the right. It looks a little bit like the good old T accounting that people might be familiar with. We've got a classified format. Assets and liabilities are grouped into similar subcategories, current, non-current, things like that. And then we've also got an interesting one called liquidity-based format. And liquidity-based format is really, first of all, it's an IFRS-based system, okay, and it allows liquidity-based presentation. In other words, assets and liabilities, okay, get presented in order of how liquid they are. So probably you would find cash right up the front, okay, because that's obviously the most liquid asset. Hopefully not liability, but it could also be a liability as well if it's an overdraft. Okay, and you move downwards to the least liquid, generally speaking, much longer term assets and liabilities. Okay, next, learning outcome statement, contrast current and non-current assets and current and non-current liabilities. Generally speaking, current assets, okay, are assets that are reasonably expected to be converted to cash, sold or consumed generally within a year, but it doesn't have to be necessarily within a year. It could also be within a normal operating cycle of the business, okay, whichever is longer. Okay, the normal operating cycle of a company is the time needed to go from cash to cash. Okay, in other words, from the time that the item started in the process, normally the purchase of inventory, until it's sold and cash is received in the form of payment of accounts receivable. Then you've got non-current assets, okay, obviously, and it's a nice easy definition for non-current assets. It's those current assets that don't meet the definition of a current asset. In other words, they're more longer term. Current liabilities, okay, current liabilities are those obligations due to be paid again. Same story like with current assets, within a year or within the normal operating cycle of the business, whichever is the longer. Okay. Certain liabilities are paid from current assets. For example, you would pay a current liability from your cash balances, okay, or you could pay them by incurring new liabilities. In other words, taking out a loan using that cash to pay the old liability, but then remember, of course, you are left then with a loan. Specific criteria for classifying a liability are as follows. It's expected to be settled within a normal operating cycle of the entity. It's held primarily for trading and generally settled within 1 year of the balance sheet, okay, or the entity does not have an unconditional right to defer settlement for a year after the balance sheet date. Does not have the right. According to IFRS, certain current liabilities might not be settled within a year, but even so, they are still classified as current. Things like trade payables and certain accruals for employees, because generally these are current because trade payables are more of a current type of a liability. Non-current liabilities, generally those that are do not fall within 1 year of from the date of the balance sheet, okay, or those that are beyond the operating cycle, okay, or those that we typically going to pay out as a result of from non-current assets. Okay, we look at working capital. Working capital is the capital that the business uses in order to keep itself operating, and it's generally defined as current assets less current liabilities. But of course, keep in mind there will be more coming up for working capital, okay, when we get to the corporate issuer section, where we deal with working capital liquidity as a bit of a separate type of a topic. Okay. An adequate level of working capital is needed to fund the business. When we say fund the business, to meet the current liabilities as they become due. It's not so good to keep too much working capital aside. Why? Don't keep too much cash available, because that cash could be better utilized elsewhere, and then we would probably tell you that you're not utilizing your resources efficiently. But on the other side, don't keep your working capital too low, as then if you do and you don't have enough cash, you may not be able to meet your short-term requirements. Okay. Different types of assets and liabilities and the measurement basis of each. Okay. Let's have a quick look. We've got historical cost, and we've seen this all before, by the way. Okay. Historical cost is the amount that the asset was purchased for initially. Same thing would then apply to liabilities. Current cost, how much would it be if we had to if that particular asset was purchased today, or that liability would be settled today. Amortized cost, remember, amortized cost, for example, if you buy yourself a longer term asset, then what will happen to that long term asset? Well, we would buy it today, but we would reduce its value. In other words, we would depreciate or amortize that amount over a certain period. Realizable or settlement value, that's the amount that it could be settled for today, okay, both the assets and liabilities in the ordinary course of business. Present value, we know present value is when we take the expected future cash flows and we present value them to today's date. Obviously, for that, and we'll see that much more in the equities and fixed income section, of course, we will need a discount rate to do that. And fair value is the amount that the asset or liability could be dealt with in a normal arm's length transaction. Okay. And what we have a look at over here, okay, is the balance really of what goes on in the balance sheet and how we will treat them. Let's have a look at the asset side. We've got cash and cash equivalents. Okay, they vary short-term in their nature, low risk. Okay, and they measured at the amortized cost or fair value. Marketable securities, for example, like things like shares that the company may own on the market, those are valued at fair value. Accounts receivable at net realizable value. Net realizable value is whatever they are worth less. Of course, if they're not going to be collected, we have an allowance or a provision for credit losses or bad debts. Inventories, and a lot of people call it stock. Okay, IFRS says we value that at the lower of cost or net realizable value, the lower of what it actually costs you or what you could get for it today. US GAAP says the lower of cost or market value, and we're going to see a lot more about inventory specific. It has its own specific learning module ×2, one in the pre-reads and then one again in the core readings. We'll see that in its correct spot. Non-current assets, property, plant and equipment. Okay, a bit of a difference over here, but again we will see this in its own section called long-lived assets. Okay, it's measured at the cost or revaluation model. IFRS says that you can value property, plant and equipment either at what it cost you, okay, or you can revalue it. Revalue it means what if the value has gone up appreciably since you bought it, something like land, property, things like that, real estate, well then you can value it upwards. Okay, don't forget to depreciate it here as well. In other words, if you bought yourself a car, a factory, anything that uses up the asset over time, don't forget to reduce it by by an item called depreciation. US GAAP says no. US GAAP says you cannot use the revaluation model, and all items, property, plant and equipment, long-term assets or long-lived assets, they must remain at their historical cost, less of course what you have depreciated them by. Investment property, okay, again IFRS says you can keep it at the cost that you bought it for, okay, or you can revalue it if it's gone up in value. US GAAP says no, you've got to keep it at historical cost. Intangible assets, we're here on page 6. Intangible assets are non-monetary assets, things like brands, a company's brand, their customer list, okay, all things like that. These come as a result that it's not a tangible asset, they're non-monetary assets, you can't touch them and feel them. Okay, for example, IP, intellectual property as well, would fall under this category. Same story, we see this time and time again. IFRS says that you value it at what it costs you to generate. For example, if you creating yourself a brand, all the costs that went into creation of that brand. Okay, if the brand becomes more valuable, well, then you can record the brand then at its revalued amount. Don't forget to write it down or to amortize it as it reduces in value. According to IFRS, purchased intangible, if you buy yourself an intangible, you buy yourself a brand from somebody else, you can recognize if they arise from a contractual right, a legal right, and they have the ability to be sold, separated and sold. For example, a customer list is then able to be recognized as an intangible asset. Internally generated intangibles will be recognized IFRS only. US GAAP, all items must be expensed if they are internally generated. Remember, internally generated if you make them yourself. Purchases if you purchase an intangible asset from a third party. Okay, and when would that happen in terms of IFRS, okay, and US GAAP? They meet the recognition as development costs. All research costs are expensed. What else gets expensed? Startup costs, training costs, admin costs, advertising and promotion, relocation and reorganization expenses, and any other kind of redundancy and termination costs. Those would be expensed immediately. Goodwill, okay, is for example, when a company purchases a business, okay, it's the purchase price that they paid less the fair value of the net assets. And the obvious question then is, why would a company buy another company and pay more for it than the value of the net assets, which of course we then term that goodwill? Well, goodwill, perhaps they've got another reason for buying the company, or they see additional value in purchasing of the company more so than the actual value then of the assets. Goodwill is not amortized. Okay, we don't write it down year after year, but we test it annually for impairment. Okay, in other words, we need to say to ourselves, is the value of what it was worth still what it's worth, or perhaps maybe it needs to be written down to a lower value. We've got financial instruments. Financial instruments are things like derivatives, things like that. Okay, we break these down into different categories. Trading securities. Okay, these types of securities are purchased for the short term to trade. The intention is to profit in the short term, and these get measured at fair value with realized gains as well as unrealized gains and losses, okay, going through the income statement. We've also got available for sale, a bit of an older one, guys, debt or equity securities. They're not held with a purpose to sell in the short term, and they're also not held to maturity, because that'll be the next category. These are measured at fair value. Gains and losses are reported in the income statement, okay, and unrealized gains and losses, those go through, remember what we spoke about in the income statement called OCI, other comprehensive income. We've also got over here held to maturity investments. We're going to see this more when we get to the non-current assets or the long-term liabilities, things like bonds and things like that. And those are either debt or equity securities. We intend to hold them to security, and those get measured as a very specific kind of measurement scheme called amortized cost. We will show you a lot more of that as we get to that particular section then on long non-current assets. Top of page 7, liabilities. Accounts payable go at amortized cost, and other short-term liabilities also amortized cost. We know about those. Non-current liabilities, financial instruments, okay, if they are trading, they get measured at fair value. Everything else would go out then at amortized cost. And deferred tax, some good news about deferred tax, okay, it's got its own section as well, okay. We will do its own separate learning module, both in the pre-reads as well as in the core readings, and that goes out then at amortized cost. Describe learning outcome statement. Describe the components of shareholders' equity. Okay, Remember, owner's equity, we always use the word residual. It's the leftover after assets less liabilities. One component is called common stock or contributed capital. That's the amount that the owners initially invested in the business, okay, in order to raise capital then for the business. They are the owners. Keep in mind they're also the last to share in the company's profits, but having said that, if the company does well, then they do very well as well. You've got preference stock, and look at the words preference stock, preferred. In other words, that they are preferred to who? Preferred to the common stock guys. In other words, that they would get their dividends and any of their payouts in the event of things like a liquidation or things like that before the common shareholders. Okay, but of course, if things are going really well, they don't do as well as the common shareholders because they are a preferred shareholder. In other words, they get dividends, but that's all that they get. They don't typically get to share in the residual profits. Treasury stock. What's treasury stock? Treasury stock is sometimes a company can buy back its own stock. It repurchases its own stock. Okay. Sometimes the management team believes that the company is undervalued and that the shares in the market are undervalued. They buy them back. Okay. They're a bit nervous that somebody else might also identify the fact that they are undervalued and might decide to take over the company. Okay. Generally, treasury stock is reported what we call a contra account. Contra account is it offsets the value then of the shareholders' equity. No voting rights attached there and no dividends. Okay, over our page, top of page 8, retained earnings. Retained earnings, that's the earnings of the company since it started, less any dividends that have been paid out and any movements to reserve accounts that would reduce or increase the retained earnings. We've got other comprehensive income. Other comprehensive income is what we typically define as all other types of income, okay, that are not necessarily related to the normal operations. These exclude all transactions with shareholders, okay, and then we've got lastly what's called NCI, non-controlling interest. Okay, for example, if the company is held majority by one and perhaps there is an outside shareholder, okay, we would then report that minority's pro rata share of the net assets that are not 100% held then by the parent company. Top of page 9, I've got a bit of a summary for you. As you can see, guys, learning module 3 is a relatively short one, a gentle one, where we take a quick look at balance sheets, remembering, of course, guys, we will see a lot more on balance sheets when we get to the core reading in the main section. And there are your here's your summary. As per usual, guys, we always take you back to the very beginning page of the notes and always just tell you guys, please do us a favor, do you a favor, okay, and go through that learning module again, okay, go through the learning outcomes for learning module 3, and just as you read through them, describe the elements of the balance sheet. Do you know about assets, liabilities, and equity? Describe alternative formats. Are you able to do that? Etc., etc. Then you have come out of the particular section and reading with a good amount of knowledge. Moving onwards then to the next learning module.